No, yeah. Yeah. It's lasting so far, but I wish you had like a somewhere out. Need more time. A couple hours.
I know, right? So many people.
Reminder that your first quiz is a week from today. Okay. So let me be very clear. It's in person, in class. The first 30 minutes of class, there will be class after the quiz. So don't leave after the quiz. So it's 30 minutes, first 30 minutes of class. So if you come late, you're going to miss a third half of the quiz. So 10:30 to 11, left the quiz, and then 11 to 11:50, we'll still have class. It'll cover everything we do through Wednesday, which will be pretty much a big chunk of risk-free rates, equity risk premiums, betas. And there's a corporate governance section, but much of that will be, if you've taken a look at the past quizzes, will take the form of multiple choice questions. I almost never ask multiple choice questions. The only area where I do is corporate governance, right? There's not a whole lot of numerical stuff that we can do. So now I'll send out the links again. I've sent them before. The review session, past quizzes, and approach the past quizzes judiciously, which is there are a lot of past quizzes there. If you start with the 1996 quiz, which is the very first quiz, and work your way through, two prompts. One is you're never going to get done, right? You're going to get to 2008 and the quiz is going to be there. And second, the earlier quizzes, there's a material might be slightly different because of the sequencing of the class. So I would start with the latest quiz and work backwards. Spring 2023, spring 2022, work backwards. So more details on the quiz coming up. It is open book, open notes. You can, many of you have your slides on your laptop or on your iPad. You can use them as slides, but no opening up Excel, none of the tools on your laptop. So it's basically calculate, act like it's an old-fashioned exam. You got paper in front of you. You got to write it on the exam itself. So there's no yellow extra scrap paper. You can just show your work and see, you know, it should be pretty much straightforward. You know, is it going to look like the past quizzes? Obviously, right? Is it going to be a past quiz? No, because then all you have to do is find the quiz and just recopy the answers. But it is going to be based on the material that the last quizzes were on. Any questions before we start? Okay. So on Wednesday, we were talking about equity risk premiums, both at the country level and at the company level. Okay. The equity risk premium is a second ingredient in your cost of equity. You got a risk-free rate. Justin, how do we get a risk-free rate for for your company? What do you have to do? Pick the currency. The 10-year treasury works if you're doing it in US dollars. Pick the currency you're doing the analysis in, find a risk-free rate in that currency. Okay? For an equity risk premium, what do we do for a company? What do we need as information from the company? Where, no, for betas, you need the business mix, but the mix of geographies you operate in. So I need a breakdown by geography of where you get your revenues, where your operations are, and I'll let you make a judgment on what you want to weight on, and you take a weighted average. And I want to reinforce that point. Your equity risk premium as a company is not based on where you're incorporated, it's where you do business. So if you can get a chance and do that for your company, you can think of it as additional material for the quiz, because in a sense, your quiz can never be as complicated as your company. That's a reality. So if you can work through the project, think of it as reviewing for the quiz as well. So today I want to talk about the last piece of this puzzle. We've talked about the risk-free rate. We've talked about the equity risk premium, but let's not forget that we started this entire process by talking about how we measure risk in a company. Is the risk added to a market portfolio? And the question is, how do we measure that risk? How do we get that beta? And if you open up any corporate finance textbook or any finance book, we make a bad mistake. We put up a regression and then we move on. In almost every finance class, in your foundations class, you probably saw that beta comes from a regression of returns in the stock against returns in the market index. This is a statistical exercise. Let's see how much you remember of your statistics. In statistics, when you run a regression, there's a dependent variable and there's an independent variable, right? When you run this regression to get a beta for your stock, which one is your dependent? Which one is your Y, dependent variable? Which one is your X, independent variable? Manish? It'll be the stock return, and the independent variable will be a market index. You run the regression, you get a slope. And then we take the slope and we throw the rest of the regression out, which is throwing away information. You're saying, what else can I learn from looking at the regression? Let's go through the output from any standard regression. Forget about a beta regression. When you run a regression, in addition to the slope, you get an intercept, right? It tells you what the level of the dependent variable will be. If the independent variable is 0, that's what the intercept is. You also get an R squared. Somebody give me in intuitive terms what an R squared in a regression tells you about the dependent, the independent. How well the independent variable explains the dependent variable, how well the market explains. Now do you see why regressions give you a measure of market risk? Because when you run a regression, the beta is determined by how the stock moves with the market, not how much it moves on its own. So one of the things I'm going to show you, and this is going to be, if you get a chance, take a look at the puzzle from tomorrow. I'm going to show you a beta regression for GameStop. Around the time when it became a meme stock and the stock went from 20 to 400 back to 25. And you're going to see a beta which is 0 or even negative. And you say, how can that be? How can you have a risky stock with a low beta? Because betas don't measure volatility. They measure what your movement looks like relative to the market. So the slope tells you what the beta is if you trust the regression. But there's one final point. If you run a regression in your statistics class and you report the output from the regression, you got an intercept, you got a slope. What else are you required to report in a statistics class on a regression to let the world know that you're uncertain? The standard error or the t-statistic, right? Built in brackets. We very quickly forget that practice once we leave those classes, which is very convenient because we never have to tell the world how uncertain we are about our own estimates. So here's what I'm going to do. I'm going to milk the regression dry. I'm not just going to take the slope. I'm going to break the regression down, and I'm going to argue that the slope of the line tells me the beta. The intercept, I'm going to argue, tells me something about how well or badly my stock performed over the period of the regression. And then the R squared tells me where the risk in my stock comes from. You might say, what does that even mean? Remember we talked about risk and return models. We talked about what portion of the risk in a stock is explained by the market. That's the only portion you get rewarded for. The R squared is going to tell me what portion of the risk in my stock is explained by the market. Now, as you think about running this regression, And we have lots of estimation parameters too. Let me very quickly talk about why the intercept tells you something about the performance of the stock. If you go back to the original CAPM, which is what we're trying to estimate all this stuff for, the expected return on a stock is the risk-free rate plus beta times RM minus RF, right? That's a standard. If I did a little algebra, I can rewrite the CAPM as risk-free rate times 1 minus beta plus beta times RM. I promise I'm not messing with the equation. I'm just moving things around. So if the stock did exactly as predicted by the CAPM, the intercept should be the risk-free rate times 1 minus beta. So I run a regression over 5 years. The stock did exactly as predicted. The intercept should come in at the risk-free rate times 1 minus beta. Then I run the actual regression. I get an actual intercept. The actual intercept, let's call it, for the moment, just A. If that number is exactly equal to, or very close to the risk-free rate times 1 minus beta, I'm going to say this stock did about as well as expected. If that number is much greater than the risk-free rate times 1 minus beta, this stock did much better than expected. And if that number is much lower than the risk-free rate times 1 minus beta, it did worse than expected. So I'm going to, without even looking at a regression, I'm going to throw a couple of company names at you. And you tell me what kind of intercept you would expect to see on the stock. Let's say I ran this for NVIDIA using 2020 through 2023 data. What are you going to see as an intercept? A big positive number, a number close to the risk-free rate? What are you going to do? A huge positive number. Mind-blowingly large. Why? Because I've picked the best performing stock in the S&P 500 over the last 5 years. If I pick Disney and ran the same regression, I'm going to get an intercept that's negative and well below the risk-free rate times 1 minus beta because the stock did worse than expected. In fact, that difference between the intercept and the risk-free rate times 1 minus beta is called the alpha. It's called Jensen's alpha. It's named after Michael Jensen, one of the pioneers in modern finance, who in the 1960s was looking at mutual funds and asking a very simple question. At that time, the hypothesis, the prevailing belief was mutual funds are run by professional investors. They must beat the market. People took it as an article of faith. They said, how can they not beat the market? You got all this information. And remember, in the 1960s, mutual fund managers had a significant advantage over the rest of us because they actually had data that the rest of us did not. They had tools that we could not use. So the presumption was that they would beat the market. So his research original idea was, let's see how much they beat the market by, because he assumed they would beat the market. And he ran the study and he used the Jensen's alpha to measure it, because basically he could see what these funds delivered as an actual alpha. And what he discovered has been become one of the most enduring findings in finance, which is the average mutual fund manager underperforms the market. It's a negative alpha of about -1 to -1.5%. Now, we can talk about why active money management collectively has a problem, but that's a topic for a different day. But that's why he concocted this measure as a measure of, hey, do mutual fund managers pick stocks with positive alphas? Because that basically becomes the entire reason for active investing. If you can find the next NVIDIA, you can't go back in hindsight and say, I wish I'd bought it, but if you can find the next NVIDIA, and you can get positive alpha stocks, or at least much of your portfolio to deliver a positive alpha, you will outperform the market. So slope is going to tell me something about risk. The intercept is going to tell me something about performance. The R squared is going to tell me a little bit about where does that risk come from? Does it come from the market, or does it come from company-specific actions? Now, before I actually run the regression, I have some decisions to make. Remember, I'm 2013. I'm trying to estimate a beta for Disney. Disney's been publicly traded since the 1950s. I could go back all the way to the 1956 or 57. So the first choice I have to make is, how far back should I go in running this regression? It's always back. You can't run forward because you don't know what the future will come. Should I go back 2 years, 5 years, 10 years, 50 years? Now, if you think purely in terms of data, remember, in statistics, more data is better than less data. You're saying, I'm going to go back all the way to the 1950s. But here you got to stop and think why you're estimating this beta. You're estimating this beta for Disney today. not Disney in 1958, 68. You want a forward-looking beta. And the trade-off you have here is if you go back too far, you're getting a very different company than the Disney of today. Almost no service that I know of goes back more than 5 years because very few companies are stable enough that you can go back more than 5 years. In fact, most use 2 years. Now, I suggested you get on a Bloomberg terminal and get the beta. The default, did anybody try that on their company? What do you know what the default period was for your beta? Can you take? Yeah. It's 2 years of returns. That's a default. But Bloomberg allows you to change it to 5 if you want. That's one of the nice things about a Bloomberg beta page is you can go in and change your starting and your ending point. 2 years is their default. S&P Capital IQ does both 2 and 5 years. But very few services do more than 5 years. And for some of your companies, this decision is going to be taken out of your hands. If you're doing Birkenstock, your beta is going to be over 6 months because that's how long it's been listed. Beggars can't be choosers. You can't sit there and say, I want 5 years of data. That it's not there. So that's your first choice. How far back do I go? 2 to 5 years seems to be the default most services use. Second choice. Yes, go ahead. That's a problem, right? A regression beta is going to be a mess. Anytime a company is shifting on you, there's no way you're going to get a reasonable beta look. And so that's one of the, as I go through the regression beta section, I'm going to dig a hole for regression betas and bury them because I don't like them, but I want to start there because that's how we're all taught how to estimate betas. Right? So that's the first choice you have to make. Second, once you've decided 2 years, 5 years, 3 years, whatever choice you made, your second choice is how are you going to break up that period? See, what does that mean? I could take 2 years of data and break it into daily, weekly, monthly. And here again is the trade-off. If I break data down daily, I'm going to get a lot more observations, right? With 2 years, I'm going to get 500 observations. Remember, there are only about 250 trading days a year. So with 2 years, you get 500. With 5 years, I'm going to get 1,250. Whereas if I use monthly data over 2 years, I'm going to get 24 observations. And with 5 years, I'm going to get 60. This seems like a slam dunk. Go with the daily data. There's more information. But here's the catch. Daily data has 2 problems. One is if your trading is not frequent and you have a trade on your stock at 3:43 p.m. and that's your last trade and the market keeps going until 4 o'clock, which it does, you get a mismatch. So daily returns can sometimes create very, very strange looking betas, which is the reason very few services use daily return betas. Annual returns are off the table. You can't, there's not enough observation. So it's really a choice between weekly and monthly. You saw Bloomberg use weekly. That is actually coupled with the fact that they use 2 years. If you use 2 years, monthly becomes a problem as well, 24 months. But again, there's no right answer. You can see why you have these choices that different services make. So Bloomberg's default is 2 years of weekly returns. Now, once I've chosen the period, broken it down into these time periods, I now have to estimate the returns on both my stock and the index on a monthly basis. Let's take the stock. Let's take Disney. Every month, I'm going to get the stock price at the end of the previous month, the end of this month, I'm going to take the change in the price. That's a price change portion of the return. But there is a second component to returns. When you buy stocks, in addition to the price change, what's the second component that goes in? Dividends. And dividends don't get delivered on a monthly basis. At least for Disney, it's once every quarter that you're going to get dividends. Don't try to be fair and spread it out over the 3 months. Put it in the month in which the stock goes ex-dividend. You know what that means? Basically, you got to buy the stock by that day to collect the dividend. So there'll be a little X next to the stock the date the dividend gets paid. So you're going to get 4 ex-dividend dates in a year. You're going to put them in, let's say, April, July, whichever months they come in. You're saying, won't that cause the return in that month to jump? It won't. Why not? If I'm putting a dividend only once every 3 months, why doesn't it cause the return in that month to kind of, and that seems like an unfair thing, right? What else happens when the stock goes ex-dividend? Yes. In fact, on the day a stock goes ex-dividend, you can watch this actually in the market, the stock price will drop by roughly the amount of the dividend. We'll talk about why not exactly the amount of the dividend. So if I pay a $1 dividend, the price drops. In fact, that's the reason you need to leave it in the month the dividend gets paid, because there'll be a price drop for the dividend. So I get the returns every month. So let's say I go back 2 years, weekly returns, I get weekly price changes, and the dividends only in the weeks the stock goes ex-dividend. Now let's turn to the market. I need a return on a monthly basis on the S&P 500. This should be easy, right? I take the level of the index, take the change in the index, I get the percentage change in the index. You can pull that off Yahoo Finance, it's easy to do. But here's what you'll be missing if you do that. Some of the S&P 500 companies, roughly 300 of them, pay dividends. So when you look at just the price change in the index, what you're missing is the dividends you would receive if you bought the entire index. It's public information you can get. It's a little bit of a pain to get, but one of the things you can get from a Bloomberg terminal is actually the monthly dividends on the S&P 500. So each month you're going to see, so with the S&P 500, you'll get dividends every month because some stocks pay their dividends January, February, March, April, and I get the index returns every month for the period. So in the case of Disney, here's what I'm going to do. Here are my choices. I'm going to start and run 5 years of monthly returns. Why? I just like the more than 2-year weekly returns. There's no theory reason. Statistically, I feel more comfortable. For the market index, I choose the S&P 500. Do you see why I use the word choose? It's a US company. Think of how many different US indices I could have picked. I mean, in fact, it doesn't even have to be a US index, right? If you go back to the original CAPM and I said, we all hold the market portfolio, what's in it? Every single traded stock on the face of the earth. So if I look just at the US, I can look at the S&P 500, I can look at the NASDAQ, I can look at the NYSE composite. The S&P 500 by far is the most widely used index by many US services for US companies. Why do you think that is? How do you justify using an index with only 500 companies when the market portfolio should include every traded stock? Yes. It's only 500 out of 7,000 publicly traded US stocks. Forget about the global question later, but it's 80% of the market cap. Right? There's another reason as well, which is that the index is, people trust the index. There's a reason you need to trust in history because you need this data going back in time. I mean, you can't use the Dow 30, obviously, because it's only 30 companies. You're saying, why not the NASDAQ? It has more than 500 stocks because the NASDAQ is really a tech index. It's not a broad. You want a broad market index. I mean, I've seen people actually, and these are people who should know better, to estimate the beta for a Microsoft, they would run it against a NASDAQ. You know what the rationale is, right? It's listed on the NASDAQ. I'm going to run it. That rationale breaks down here. This is about getting a beta against an index that captures as best as you can the market portfolio. And here I think services have a problem. They're very parochial. Now, as I said, for US stocks, services use the S&P 500. For a German stock, they use the DAX. For a French stock, they use the CAC. It's always localized. I've never understood why they've not shifted. Because that might have made sense 40 years ago when the typical investor in a company was a domestic investor. And especially in Europe, think of the change that the EU has brought about, right? German investors invest in French companies, French investors invest in Italian companies. I think the argument for using local indices is breaking down, and I'm still waiting for the first service to break from the pack and say, what would be the logical thing to do to estimate the beta for every company in the world then? Run it against? That would be a pain in the neck because then you'd have to do it on a weekly basis the weights will change every week. But does somebody do that already? Take all these different markets and come up with an index that captures global equities? Which is just 5,000 US stocks. Have you heard of the MSCI index? It's the oldest global equity index out there. It's not a very good index. The reason I'm reluctant to jump on the bandwagon, it's an index that samples stocks in each market. It doesn't take a full picture of the market, but it's been around forever, and many global portfolio managers get judged against the MSCI. Incidentally, one of the nice things about the Bloomberg beta page is you can change the index that's in there, which is defaulting to the domestic index to any other index, including the MSCI global index. So leave that open here for the moment. I'm going to stay with what most people do and use the S&P 500 as my market index. So to calculate the returns each month, let me give you a sampling of 1 month, December 2009. The price for Disney at the end of November 2009 was $30.22. At the end of December, it was $32.25. So during the course of that 1 month, the stock went up $2.03. It was a good month for Disney. During that month, there was also, it was an ex-dividend month. There was a 35-cent dividend. So to compute the returns for Disney in December 2009, I take the change in the price, $2.03, add the dividend, and divide by the price at the start of the month. Don't do crazy things like averaging the price. And here's why. You bought the stock at the start of the month, you pay $30.22. At the end of the month, you get $32.25. The return should always be based on the price at the start of the month. So in December 2009, Disney's return was 7.88%. In the same month, looking at the index went from 1,095 to 1115. So change in the index, it went up. I looked up the dividends in December. December is a low dividend month for stocks because they declare the dividend comes out in January. So in that month, the actual dividend was relatively low, but it was at 1.683. You add that on, divide by the index at the start of the month, I get a return for the index of 1.78%. I do this for every month for 60 months. Sounds like a lot of work, but with an Excel spreadsheet, once you got the prices, the dividends are the paid, actually. The prices in the index you can download from Yahoo Finance, or, so even if you don't have access to a Bloomberg, but the dividends are a bit of a pain to do. You got to collect the information separately, and you run the regression with those 59 months of returns. Notice how I lost a month. I said at 60 months of data. Where do I end up with only 59 returns? I need a change in the price, right? The first month, I can't do a thing. So I've got to wait till the second month to get the first return. So whatever the number of months or periods you have, the returns you'll have will be that -1. So I did this for 59 months. The first time I did it in Excel each month for the Disney and the index. And then I created a scatter plot. I know this is a throwback to statistics. You thought you were done with that crap. But guess what? It comes back to haunt you. But remember scatter plots and statistics, you got a dependent and independent variable in a scatter plot. So each point here is a month of data. So every month I look at Disney market, I plot that point. So if you want to count and you don't trust me, if you count the number of points, there should be 59 points on this graph. And then I have a best fit line. We'll come back and talk about it. See this line that's fit through? That's my best fit line. How do I get a best fit line? I could take a ruler and say, that looks pretty good. No, but that would be pretty subjective. How in statistics do we get a best fit line through this scatter plot? So what's the criteria for a best fit line? Anybody try? You minimize the squared distances from the line. The Greeks, when they first started to think about regression, the Greeks were ahead of everybody else. They actually measured the distance of each point and squared it. Think of how much more work that was. And then they minimize the squared distances. That's what a statistics package does for you. It's not magic. It's fitting that line by looking at minimizing. That's why it's called an ordinary least squared regression. There are variants and regressions where you might, you can vary that. But this is just a traditional. So when you run Excel regression, this is what's happening in the background. Now, first, when you look at that regression, if you had an R squared of 100%, what should you see on this graph? Every point should be on the line, right? The more scatter you get off the line, the lower your R squared. Don't try to sit there and try to improve your R squared. That's not the end game. You're trying to get a sense of where does the risk in my company fall. You will never get a regression of 100%. Let me take that back. There is actually the S&P 500 index fund. You ran a regression against the S&P 500, your R squared is going to be pretty close to 100%. Not quite, because the dividends are not in the, might not be in the index fund, so you might have to do some adjustment. But if you take an individual company, your R squared is going to be less than 100%. So I'll start with that. In this case, when I ran a regression of Disney against the S&P 500, the R squared I got was about 73%. We'll come back and talk about what that tells us about Disney during the specific time period. Let's break the regression further. The slope of the line was 1.2517. It's a little bit of an overkill to carry it to 4 decimals, but let's for the moment at least carry it to 4 decimals, 1.2517. The intercept is 0.0071. And keeping with what I said earlier, I've also reported the standard errors below those numbers. Now, what I'm going to do is take this regression and use it the same way a doctor would use that first physical checkup. You find a new doctor, they say, I'm going to run a full physical on you. This is your first acquaintance with your company's risk profile. So I'm going to use this regression to get a better sense of what Disney did between 2008 and 2013. So let's start with the intercept. Remember again, what does the intercept tell you? It tells you whether your stock was a good or a bad investment during the period of your regression. It's a post-mortem. You're looking backwards. So I start with the intercept, 0.712%. Saying it was 0.007, these were in decimals, so basically you moved the decimal point, 0.712%. So the question I'm asking, is that a good enough number? I need to compare it to the risk-free rate times 1 minus beta. And here there's a little mechanical adjustment I've got to make. These are monthly returns, so my risk-free rate also has to be in the same terms. So I compute a monthly risk-free rate. I mean, when you look at T-bill rates or T-bond rates in the US, remember they're all annualized. So last week I invested in T-bills. It told me I was going to make 5.06%, but it was a 6-month T-bill. I'm not making 5.06%. I'd love to make 5.06% over the next 6 months, but I'm going to make about 2.5%, not quite half 5.06 because there's a compounding effect. So when you look at any rate specified out there, it's an annualized rate. So I take the annualized rate and convert it into a monthly rate. During this period, the average annualized T-bill rate was about 0.5%. I divide by 12. You could do compounding, but it's not worth it with this. I get a monthly risk-free rate of about 0.04%. I know it sounds messy. We're going down the side path, but I need to go down it because I want to compute what the risk-free rate times 1 minus beta would be. If you go back to the regression, there's my beta, 1.252. So 0.042% monthly risk-free rate times 1 minus beta gives me minus 0.01%. You're saying, what does that even mean? If Disney had done exactly as predicted during the period of this regression, the intercept should have been minus 0.01%. The actual regression was 0.71%. The difference, 0.72%, becomes my Jensen's alpha for Disney. And your first reaction when you look at the 0.72% is that's not very much, but that's on a monthly basis. If you make 0.72% a month for 12 months, it works out to 9.02% a year. There's a compounding benefit you get, but it's about 9.02% a year. During the period of this regression, Disney had a Jensen's alpha of 9.02%. I'm going to put some clothes on this Jensen's alpha because by itself you're saying, what does it even mean? This is a risk-adjusted, market-adjusted measure of performance. Let's play a game. Let's assume the market was up 30% during the course of this year, the 5-year period, on an annual basis. And let's say the stock had a beta 1.25. Forget about the risk-free rate. If you have a stock with a beta 1.25 in a market that's up 30%, how much should the stock be up just to break even? 37.5%, right? 30% times 1.25. When I say the Jensen's alpha is 9%, I'm saying this stock made 37.5% plus an extra 9%. That's why it's risk adjusted and market adjusted. If the market is down, I'm not asking my company to do miracles. All I want it to do is be less down than it should be, and I'm going to give it a positive Jensen's alpha. Conversely, if the stock delivers less than that expectation, the Jensen's alpha will be negative. So when people talk about alphas, and active investors love that term, this is what they're talking about, is a risk-adjusted, market-adjusted measure of performance. And you can compute this for every stock in the market, right? I'm not going to do it because obviously it's just painful to do, but I take, starting with A, work all the way through Z, compute the Jensen's alpha for every stock. I have a kind of a general question about Jensen's alphas. Let's say I've done this for every stock. What should the average Jensen's alpha across all stocks be? You want to try? What should it be across all stocks? I have 6,000 stocks. I have the Jensen's alpha for every one of them. 0? Tell me why. But what is it about what I've done that makes it 0? What if the market's up that period? Why can't every stock have a positive Jensen's alpha in a period where the market is up 30%? Why shouldn't every stock's Jensen's alpha be negative when the stock market is down 20%? How do I get the expected return? I start with the market, right? By starting with the market, when the market's up, I'm setting my expectations higher. If the market does badly, I bring my expectations down. By definition, stocks can't beat themselves, right? So when you tell me the collective Jensen's alpha for all stocks is 3%, I'm going to look at it and say, how can that be? How can you collectively beat yourself by 3%? So for every NVIDIA, and I know you're saying, I wish I'd bought NVIDIA. If the average Jensen's alpha is positive, what does that tell you about? There has to be an anti-NVIDIA out there, right? So while you're losing sleep, say, I wish I'd bought NVIDIA, here's what I'd suggest you think about. Say, thank God I didn't buy that stock that's the anti-NVIDIA that was down 98% over the last, it could be 23andMe. It's down, what, 96%? We lose so much energy and time worrying about things we should have done. And, we think about all the good stuff we've missed, but think all the bad stuff you missed as well because you were either didn't have the money or you were not even looking at that time. So the average Jensen's alpha, it's actually the market cap weighted average. And that's significant because last year, there were 7 stocks that carried the market, right? You could take the Jensen's alphas for those 7 stocks. That Jensen's alpha is weighted by the collective market cap of these stocks. Does anybody know what the collective market cap for the 7 companies was at the end of 20? It was 12 trillion. Do you see how you can have 7 stocks have positive Jensen's alphas and everybody else could have negative alphas? But if the 7 stocks that have the positive alphas are huge companies, you can effectively end up with many stocks. And last year, more than 70% of stocks had negative Jensen's alphas. So this isn't symmetric, where half the stocks beat the market, half do badly. It depends on which stocks are beating the market. And if those stocks are big stocks, you can essentially end up with a kind of an unbalanced market like we did in 2023. Disney had a positive, yes, go ahead.
When you're bidding a stock, how much do you blend this technical?
Never. Because this is classic technical analysis, right? You might have heard of relative strength, that technical analysis. Relative strength is just take the price today divided by the price a year ago, and you look at the ratio. So if you have a high ratio, you buy the stock. If you have a lower, a ratio less than 1, you sell the stock. Effectively, you're assuming that past performance will seep into future performance. So people who are momentum investors go for stocks which are big winners, hoping the winning. People who are contrarians who exist at the same time do the exact opposite. So there are technical analysts or price-based strategies, but if you're an intrinsic value person, it's nice to know, but it doesn't tell you much about the future. Now, I can't say that's better than the other two. It's just a purely empirical statement. I don't use it, but there are lots of people who do.
You're not really thinking about it.
Well, it plays into your story, right? Because that question, and this is why I think the second question becomes relevant. You ask, why did the stock have a positive or negative alpha? Let's take Disney. Between 2008 and 2013, the Jensen's alpha was a big, nice 9.02%. So, Bob Iger gets up in front of the shareholders and say, look, I did well for you, positive alpha. I deserve a bonus. This is the generic question I'm asking. Should you be rewarding companies with high positive Jensen's alpha, so the manager of these companies for doing a good job, and punishing companies with negative Jensen's alphas because you're a bad job? I'm going to come back to you. Do you think we should attribute positive alphas to management? They had some role, right? But let me give you another example. In 2022, every single oil company had positive Jensen's alphas. And why do you think that happened?
Everybody else.
No, it's just oil prices went up. You don't even need to look outside, right? If oil prices go up 30%, every oil company, you could be the most horrifically bad manager on the face of the earth. But if the commodity that you're producing goes up 50%, you're going to look like a genius. So if I were looking at ExxonMobil in 2022, I can't just look at the positive Jensen's alpha as a manager. What would I need to bring in to make the judgment? Because ultimately we care about, is the management good or bad? So what would I do there, you think, to adjust for the fact there was... Exactly, right? So if you go to my website, I compute the average Jensen's alphas by sector. Because when you do this for your company, notice I'm nagging you, if you haven't picked a company, pick it now. Okay? Take the Jensen's alpha, but don't just not admire it too much, even if it's a positive. No, look at the sector and say, was this a company that was carried up by a sector doing well? Or was it a company with the management? So you can actually a company where the Jensen's alpha is negative and you reward the management. Why? Because it's less negative than the typical company in that sector. And well, I've answered the final question, which is, if you have a positive Jensen alpha, what does it tell you as an investor? I'm going to leave that judgment to you because I don't read much into it. I'm not going to buy NVIDIA because it's done well over the last 3 years. Are there people out there who do, though? There are a lot of people who are momentum investors. Many people who claim to be value investors are disguised momentum investors. They find a way to pick last year's winners now, right? Which is not a great way to make money. And this might explain why the average active mutual fund underperforms the market by 1.5%. This is lazy, sloppy, and asking for trouble. And guess what? All three get punished by markets eventually. But people do chase past winners. Just as there are the people who do the knee jerk. They went up a lot last year. It must come down this year. You see both groups now with NVIDIA playing this out. You can't tell which is the winner until after the fact, but this is essentially something that's always been part of markets. You got any questions on the Jensen's alpha? Let's move to, so that's the intercept. It tells you what your stock did during the period of your regression. Let's move on to the slope of the line, which is the beta. The beta in the regression was 1.25. The regression slope. But I also gave you a standard error in that number of 0.10. I don't know whether you remember your statistics well enough to help me out here. But if I have a slope of 1.25 and have a standard error of 0.10, in statistics, if you ask me what the beta is for the company, I should never give you a point estimate. Point estimate would be a single number. But if you push for a point estimate, I'd give you the 1.25. But if I were honest about what I've actually discovered from the regression, I should give you a range, right? The range is going to be based on the standard error. So if I asked you with 67% confidence to give me a range, Justin, could you give me a range? What's 67% confidence is roughly one standard error. So plus 0.10, minus 0.10, 1.15 to 1.35. 95% confidence is roughly two standard errors. So plus or minus two standard errors. 99% confidence is roughly three standard errors. Next time you see a beta on Bloomberg, remember, that's the point estimate they're reporting. There's a standard error. In fact, the Bloomberg beta page that you have for your company, and I'll go through the page, actually has a standard error of your beta. It's right there. Nobody seems to use it. But it's like a red light flashing on some company saying, don't use this regression beta because it gives you the range of the beta. So the slope gives you a measure of the risk in the stock. And again, remember, nice thing about beta is they're scaled around 1. To the degree that your stock has a beta higher than 1, like Desi is, it's telling you that Disney is riskier than the average stock if you define risk as risk added to the market portfolio. Beta less than 1 basically means you're less risky than the average stock. And we'll talk about what happens when your beta is 0 or negative, because that can happen too. No. As I said, no, every service puts out a beta as if it's a fact. But the truth is they're all running these regressions. They all have the standard errors. It's a dirty little secret of beta estimation is how big those standard errors can be for stocks when you run the regression right. The median standard error for US stock is about 0.2 to 0.25. So next time somebody tells you the beta for Coca-Cola is 1.15, remember all they're telling you is the true beta could be anywhere from 0.65 to 1.65. There's a big range in the beta. And I told you I was going to dig a hole for regression betas. This is one of the reasons to mistrust regression betas. Which brings me to the R squared. The R squared in my regression was 73%. What does that tell me? It tells me how much of the risk in my stock comes from the market. The remaining risk is company specific. Now, what are examples of company specific risk? You know, Disney movie comes out and a new Avengers movie comes out, it crashes and burns. It's a $500 million movie. That's company specific risk. The economy slows, the number of people coming to the theme parks drops off, that is a market risk. So when you think about risk, break down what kinds of risks show up in the R squared and what kinds of risks show up in the company specific portion. So the R squared basically measures how much of your risk comes from the market. I've been tracking these R squareds now since the early 90s. And one of the things that 2008 seemed to do across the board is increase the R squared across all companies. Any ideas why that might have happened? What is it that we've seen post 2008? Go ahead. Yeah, but still, I mean, you have enough active investors to cause the price to move. I mean, if everybody were a passive investor, you might say there's no company-specific information being priced in, but you still have companies reporting earnings and there's company-specific information. So that might be part of it, but it can't be a big part of it. Globalization is one big thing, right? When you look at your risk in investing now, especially if you're a US investor, and maybe this is the US-centric portion of the world. In the last century, in fact, value investors, you said, don't worry about the market and macro things, just go pick good companies. And it worked really well for the century. Why? Because the US was the center of the global economy. You could look at the macro risks were small and they averaged out and they took care of themselves. 2008 was a reminder that the 20th century was over. It took 8 years after the century actually passed. It was a reminder we're now globalized, which means everybody's problem is everybody else's problem. There's far more macro risk now driving stocks, and that's bad news for stock pickers. Why is it bad news? Because the old days, you were a good stock picker, the macro things kind of washed out, you emerged as a winner. This century, you're a good stock picker, you picked the stocks at the wrong time and macro risk came and hit you, you're not going to recover from that. And maybe one reason value investing has kind of dropped off, both in favor and in returns, might be the shift away from a micro world to a macro world. In emerging markets, this has always been true. In emerging markets, you knew even if you picked the right stock, if something happened to the country, you could not be rescued. Today, we're all like emerging markets in many ways. That macro risk component is washing out the micro risk component. Yes? I don't think we're getting better. We're actually getting worse, right? Part of it is the passive investing. We're doing less work. So human beings collectively don't get more intelligent over time. And that's my cynical conclusion. You can give them more data and you can give them better tools, but they still do the same things. The behavioral things that drive us, greed and fear, are just so overwhelming. They wash out all the good stuff. Okay. So let's do one more test on R squared before we leave it behind. So the R squared tells you how much of the risk in a stock comes from the market. Let's assume you have two stocks which have exactly the same regression beta. In this case, let's call it, take Disney and Amgen. They both have the same beta, 1.25. But let's say Disney has an R squared of 73% and Amgen has an R squared of only 25%. So less of the risk in Amgen comes from the market. You're a diversified investor trying to decide which, let's say the cash flows, earnings, everything else about them looks identical. The only thing they're different on is one is a high R squared, the other is a low R squared. As a diversified investor, which one of these stocks is a better pick for you? Amgen, because it is a lower R squared, Disney because of the higher R squared, or would you not care? You want to try? What do you think as a diversified investor? And tell me why. But you're already diversified, right? If you're already diversified and you add Amgen, it's going to get washed out. But it would have been, so if you were in the process of diversifying, you say, I want the low R squared. But if you're already diversified, there's no real gain you get from the lower R squared. Anybody want to go with a higher R squared? If you're diversified, you're going to get rid of the company specific risk. The last thing you care about is the R squared because you're paying no price to buy. So, because one of the things you worry about when you buy low R squared stock is, what about all that company specific risk? Remember, you're not getting rewarded for it. But if you're diversified, you get rid of the company specific risk. I've kind of answered the second part of the question. If you're one of those concentrated investors, remember I told you the typical investor individual investor in the US owns 3 to 5 stocks. Then would the R squared make a difference? You want the high R squared stock or the low R squared stock? Your greed and fear will push you in different directions, but let's see which one wins out. Greed is going to push you to the lower R squared. Why? Because a lot more companies, you say, I could make a lot of money here. The fear factor is now you've got a stock with a lot of company specific risk. You're not diversified. You're exposed to risk you're not going to get rewarded for. You could get taken to the cleaners. For God's sakes, if you own 3 or 5 stocks, don't make them NVIDIA, some small biotech company, because you are going to be exposed to a lot of risk for which you're not going to get rewarded. So if you're a diversified investor, R squareds don't matter. But if you're a non-diversified investor, you're a concentrated investor, you might want to get the highest R squared stocks in your portfolio because you don't want to be exposed to company-specific risk. It's still going to be in your portfolio. And there the R squareds will matter. So no, Fidelity Magellan shouldn't be looking at the R squareds of stocks. But you and I, we want to be concentrated investors, should probably care about where does the risk come from and worry more about the company-specific risk. Which leads you at the limit to an index fund, right? Because there the R squared is 100%. You can see the less confident you feel about picking the company-specific risk that will work in your favor, the more you'll move to an index fund. Now, until I think 2002, which is when we got our Bloombergs, as part of this class, at this point, I would ask you to run the regression for your stock. It's not a big deal. You have to go collect the prices. You got to put them in an Excel spreadsheet, get the dividends, but it's just a tedious job. It's not difficult, but it's tedious. I think somewhere 2002 or 2003 is when we got our first Bloomberg terminals for the school. They're incredibly expensive. Don't try to get one at home. It's like $100,000 a year, right? So, but if you go to any investment bank, they're all over the place. So they gave us, they were very charitable. They said, we'll give you 3, we'll charge you only 50,000. And now we have like 4 for the MBAs. So the 4 that I pointed to, I think they're in the MBA, the 4th floor of KMEC. One of the nice things about a Bloomberg is you can bypass this entire process and run the regression much more quickly. So I found a Bloomberg terminal and I decided to check to see whether the regression I ran gave me the same numbers that Bloomberg gave me for Disney. So I went into the Bloomberg terminal. I did change the default from 2 years to 5 years, from weekly to monthly, because I wanted to match up to what I did. So I'll take you through the output from the regression. And I wanted to compare it to the output that I had 3 pages ago when I ran this in Excel. Let's start with the raw beta, 1.247. Pretty close, right? I had 1.252. They got 1.247. If you round up, 1.25. I'll come back to the adjusted beta in a minute. Then they have some bad wording. They call the intercept the alpha, which is confusing because it's not a Jensen's alpha, just the intercept. And their intercept was 0.60%. You remember what it was in my regression? I think it was 0.71%. Incidentally, Bloomberg is very sloppy about percentages and decimals. That 0.59 is not 59.9%, it's 0.59%. The first time I ran this regression in about 20 years ago, this is the part where I got stuck on. Why is Bloomberg's intercept different from mine? The beta is pretty close, but the intercept. And the answer is actually surprisingly easy to find. When I ran the regression, remember I included dividends in both my stock and the index, but it was a bit of a pain, right? Because it's once every 3 months for my stock, you have to collect. Bloomberg's beta regressions are run entirely with price returns. Okay. Why? Because the computer is running them. It's not, there's no person out there running the regressions. It's run with, so the dividends are being ignored. It doesn't make a big deal on the beta because for most stocks, dividends are such a small part of their total returns that they get washed out. But you can see the kinds of companies where Bloomberg beta regressions are going to be a little misleading. Companies with big dividends, real estate investment trusts, some banks. There, the Bloomberg beta regressions can be a little off-putting because they're not including the dividends as part of their returns. Let's keep going. R squared, 73%. As you can see, the beta and the R squared are pretty close. The intercept is really close to, it's 0.11%, right? So it looks large, and if you think in terms of absolute numbers. But I'm getting pretty close. So here's what I'm going to do. I'm going to ask you to run the beta regression using Bloomberg, so you don't have to go through the tedium. If you really, really wanted to do it by hand, you can do it. It'll take you about 30 minutes to do in Excel. But basically, the Bloomberg beta page will give you the beta for your company. So the standard error of the beta is right there. The standard error of the alpha is right there. They even run a t-test if you're interested. But this is the same regression that I ran in Excel. Now, I'm going to talk about one more number, the adjusted beta, because that is the beta you will see as the beta reported by Bloomberg for your company if you don't run this page, because it's actually in the description page. The adjusted beta is adjusted for nothing. It's actually just the raw beta times 2/3 plus 1/3 times 1. You're saying, what? Say, take an example of a company where the raw beta is 1.8. The raw beta is 1.8. The adjusted beta will be 1.53. 2/3 times 1.8 plus 0.33. If the raw beta is 1.5, the adjusted beta will be 1.33. Raw beta is 1.2, the adjusted beta will be 1.13. The raw beta is 0.6, the adjusted beta will be 0.73. See what Bloomberg's doing to the raw betas? They're moving them towards 1. Why? What's so magical about 1? It's the average for the market. They're trying to be helpful. They said your company will probably get more like the market. It'll get bigger. It'll get more diversified. They're trying to help you. To which your response, please stop helping. Because these weights, 2/3 and 1/3, are the same weights they use for every one of the 40,000 companies Bloomberg estimates adjusted betas for. If you don't believe me, print off the beta page for your company, take the raw beta, multiply by 2/3 plus 0.33, you'll always get the adjusted beta. In fact, prior to 2015, they actually used to report the adjusted beta number right below. They've magically taken it away to leave some mystery in there as to what the adjustment is, but the adjustment is exactly the same. You say, why 2/3 and 1/3? I didn't know the answer. So first time I ran this a long time ago, I called Bloomberg, not the mayor, but the company. Yeah. And I said, I'd like to talk to somebody about your beta calculation page because, people using it, I want to know something about your adjusted beta. They put me in touch with the beta calculation guy at Bloomberg. There's a guy at Bloomberg's entire life is maintaining this page. Imagine how exciting his life must be. I think they keep him locked up in a basement room, feed him through a hole in the wall. He was pathetically grateful to get a call from the outside world. He says, I'm so glad you called. I have all day to answer your questions. All day to ask him the questions. So afraid if I hung up the phone too soon, he'd do something rash. So after a couple of minutes of polite conversation, or what I thought was polite conversation, I hit him with the question, why 2/3 and 1/3? Why these weights? They seem to work for 40,000 companies. They must be magic weights. 2 minutes of silence. I can hear papers being rustled, terminals being turned off and on. Finally comes back on. He says, I don't know. It was here when I got here. So what do you mean? He said, I hired 2 years ago. It was already there. It's not my fault. I'm not trying to tell you it's your fault. I want to know where the numbers came. He had no idea. You know how often that is the answer to numbers you use every day at your job? So why do we do this? I don't know. It's here when I got here. When did you get here? 1979? You've never stopped and asked? No, I don't pick up rocks and look to see what's under them. Here when I got here is I think, one of the most dangerous responses you can give in finance. But nobody at Bloomberg seemed to have an answer. So I did my own digging. I'll send you the original source. It was a paper written in the early 1970s by a guy called Bar Rosenberg, who taught at UC Berkeley. He's a finance professor. And he talked about the tendency, no, actually before that, professor at Wharton he took 100 companies, only 100 companies, because in those days you had to do this by hand. And he looked at what happened to their betas over time. And over 10 years, he noticed the betas for all 100 companies seemed to move towards one, with roughly this 2/3 and 1/3 weight. Bar Rosenberg was the editor of the Journal of Finance, working at UC Berkeley. He saw this paper and said, this is neat. And Bar Rosenberg at that time started BARA, which was one of the first beta estimation services in the world. It's based in Berkeley. And guess where he got all his ideas on how to estimate betas? He looked through these old journals that he'd been an editor on and said, this looks interesting. So in the early 70s, BARA built in this tendency for betas to move towards one into their beta estimates. And then every service since has borrowed the 2/3 and the 1/3. To cut a long story short, all the adjusted beta is telling you is which direction one is, right? And none of us should have any questions about which direction. You start at 1.8. You know how to get to one. You go 1.7, 1.6, 1.5. You don't need somebody to hold your hand and say, let me give you a number closer to one in case you're confused. There's zero information in the adjusted beta. So if you do the beta page from Bloomberg, just stick with the raw beta. Draw a line through the adjusted beta. There's nothing you're learning about the company. So I think I'm ready to bring all of the different numbers we've talked about so far. It took us 100 pages to get there, but we're there, right? We don't want a hurdle rate. Risk-free rate for Disney is going to be the UST bond rate. Why? Not because it's a US company, but because I'm doing everything in US dollars. November 2010 year bond rate. The equity risk premium for Disney is 5.76%. If you remember, that came from looking at where Disney gets its revenues. It gets 82% of its revenues in the US, 18% from the rest of the world. That weighted average is 5.76%. The beta, if I trust it, and remember it comes with the range, but if I take the point estimate of 1.25, I put the numbers together, I get an expected return of 9.95%. Risk-free rate plus beta times equity risk premium. In finance classes, you do this ad nauseum, right? Risk-free rate plus beta times, you call it ERM minus RF, but that's a risk premium. So I have a question. What does that 9.9, if let's say you were sitting here in November of 2013, you were potential investors in Disney. You're thinking about investing in Disney. What does that 9.95% tell you as potential investors in Disney? I'm going to read a few statements and you tell me whether these are fair descriptions of the 9.95%. 9.95% is the return you can expect to make in the long term on Disney if the stock is correctly priced and the CAPM is the right model for risk. How many qualifiers did I put in that statement? Let's see. I can expect to. So no guarantees. In the long term, don't come to me 2 years from now. If the stock is correctly priced and the CAPM. That statement is technically true, but it's dry. If you believe markets were efficient, this is your expected return on an annual basis. There's nothing wrong with believing markets are efficient. But here's the way I prefer to read the 9.95%. It's the return I need to make on Disney to break even on the stock. Suddenly I've become very needy. The T-bond rate is only 2.75%. What do I need to make 9.95% on Disney? Why not? Why can't I just settle for 2.75%? Because I'm exposing myself to danger, right? Remember what we said, if you're exposing danger, you want opportunity, you're demanding the extra premium because you're exposed to risk. I need to make 9.95%, which is higher than what I need to make on the entire market because Disney is riskier than the market. So one way to think about what you're getting from the CAPM as this number is this is the return you need to make on the stock. And if you're in my valuation class, that's all the rest of the class is about is do I think I can make more than this number? Because if I do my own research on Disney, I look at, where they are and the management changes that are coming, the new, ESPN headed sports, streaming network. And I am pretty optimistic about Disney. And I conclude they can make 12.5% on an annual basis. That becomes my buy. A stock is a buy if you expect it to make a return higher than the 9.95%. It's undervalued. And it's a sell if you expect to make. So one of the things I actually did for the Mag 7 stocks, I computed an IRR, what you can expect to make as a rate of return. NVIDIA, that expected return is 7.15%. Not a bad annual return, but less than the 8.3% you would need to make. So if you're buying NVIDIA, it's not a terrible investment, but you're just going to struggle to catch up because the price will have to readjust to deliver that expected return. So the 9.95% becomes the return you and I as investors need in the stock. So when you do this for your company, you plug in today's risk-free rate, the beta that you believe is right for your company, the equity risk premium reflecting where your company operates, you're getting a sense of what you need to make on this stock to break even. If you think you can make more than that, and that's a valuation judgment, then it's a buy. If you think you'll make less than that, this is a stock to avoid. Any questions on the expected return calculation? So your potential investors in Disney, you need to make 9.95%, right? If I'm the CFO for Disney, who are you? You're my equity investors, right? And you need to make 9.95%. This is why the same number is my cost of equity. We're looking at it from two sides of the picture. Your investors needing to make it, and I as the CFO say, look, I need to deliver 9.95% to you, not even to make you happy, just to keep you in steady state. So when I look at a project, and let's assume Disney is the typical project, a median project for Disney, and I look at the return on equity, let's stay with an accounting return for the moment, just because we don't want to bring in cash flows and complications. If I look at the return on equity on a project, I need the return on equity to be greater than 9.95%. So this is why it becomes my hurdle rate. What you need to make to break even becomes my hurdle rate for equity investors. We still haven't looked at the debt and the cost of debt, but for equity, we've now got a way of attaching a cost to it. I actually remember a while back having this conversation with the CFO of a very large Asian company. I won't name the company. So I went through the process. I came up with a hurdle rate of 12% in the local currency. And he said, that's not my cost of equity. I said, what do you think it is? He said, it's 1.5%. You know what he called his cost of equity? When you borrow money, what do you call your cost of debt? It's what you have to pay as interest payments on your debt, right? When you raise equity, you don't have interest payments, but what do you pay to your shareholders? You pay dividends. He was using his dividend yield, which is 1.5%. If I use that measure of cost of equity for Google, what's the cost of equity? It pays no dividends. But there are people out there who essentially view that as a cost of equity. So I told him that doesn't make any sense. That's just the dividend portion. When investors buy your stock, in addition to receiving dividends, you want price appreciation. The cost of equity I'm computing includes the price appreciation. He laughed and he said, what if I don't deliver that? And this is, I think, why I spent so much time on corporate governance to start this process. Because when you don't pay interest on debt, what happens? You default, you go bankrupt. When you don't deliver price appreciation, you disappoint your investors by taking bad projects. You don't go bankrupt. What happens? The stock price drops. So I told him that's what's going to happen. He said, I don't care. We're a mature company. We don't plan to raise equity. So what does it matter what my stock price is? So I tried to hit him with what I thought would convince him, which is if your stock price drops, why should you as a CFO care? You might lose your job. And he laughed even more. He said, do you see my last name? Do you see the name of the company? Do you see their match? And this is where I think if you're in a world where corporate governance is dead, where you're not scared of your shareholders, you will view equity as free capital. Because what can they do to you? You're going to take terrible projects. It's other people's money. Without consequences, equity at publicly traded companies can very quickly be invested in terrible projects because you have no recourse. Legally, you can't sue them, right? You can go to the Delaware courts and they took bad projects. Try. It's not going to work because they give management a huge amount. And remember, the worst projects for your shareholder are big acquisitions. Bad corporate governance and bad acquisitions go together because there are no consequences to earning less than your cost of equity. So when you compute this for your company, I want you to connect it to what you've already should have discovered about your company in terms of corporate governance. Maybe you're doing a family group company. Maybe you're doing a publicly traded company where there are no activist investors and managers are not accountable. You will get a cost of equity, but add the qualifier. This is what they will need to make to break even, but it's entirely possible that they don't care because they're not afraid of their shareholders. So what I'd like you to do is, first pick a company. Obviously none of this is relevant if you haven't picked a company. And I'm glad to see the master class list getting filled out. Print off the Bloomberg beta page for your company. And then take that beta page, just like I did for Disney, and do the standard. What's the slope? What's the intercept? What's the R squared? And then do the same things I did with Disney. Was it a good or bad investment in the 2 years? So you can stay with the 2-year default if you want to. You can change it to 5 years if you want. I'll leave the choice to you. And you can say, was my stock a good or a bad investment over those 2 years, looking at the Jensen's alpha. Okay? And follow through by looking at the range on your beta and what the R squared tells you about your company. So let's say you've got this for your company, right? Because if you think about that equation, risk-free rate plus beta times equity risk premium, the risk-free rate and equity risk premium are going to be roughly the same for most companies, unless you're a US company with a huge emerging market exposure. So I wouldn't expect your equity. So if you have 5 US companies in your group, I would expect their risk-free rates to match because you're doing everything in dollars. I'd expect their equity risk premiums to be pretty similar. There might be a little difference depending on geographic exposure. The one number where there can be significant differences across your companies is going to be the beta. The risk of being simplistic, high beta companies will end up with high costs of equity. Average beta companies will end up with average cost of equity, and low beta companies will end up with low cost of equity. I'm going to push that to its limit. Let's assume that you are the CFO of a very risky software company, and you ask me to come up with the cost of equity for your company. So I go find the beta for your company. Let's say your beta is 2, beta is 3. You're a very risky company in terms of market risk. And I come up with a cost of equity of 20% for you. You can see why a high beta is going to give you a high cost of equity. So I tell you that your cost of equity is 20%. Are you happy or unhappy about this number? Is it making your life more difficult as a CFO to have it? Absolutely, right? 20% hurdle rate means your projects have to make a 20% return. So you come back to me with a very plaintive question. You say, is there something I can do to bring my beta down? Because I've told you, the beta is the culprit. It's not the risk-free rate. You can't do much about it. Not your equity risk premium. So the question I want to ask you, and this is going to lay the foundations for the next thing we're going to do on betas, is where do betas really come from? Is what are some of the actions you can take as a company to bring your beta down?
Maybe you can invest in another company that has
or they take your money and buy T-bills, right? So if I brought my beta, so if I can invest in a safer business, remember beta is high because I'm in a risky business if I go into safer businesses. Or if you're a software company and you create a subscription model, remember the old software companies, you had to sell much riskier business and creating. So maybe you can change your business model to reduce your risk or go into safer businesses. Any other suggestions? Of course, the catch there is danger and opportunity, right? So many of the safer businesses will deliver much lower returns as well. What else can I do to bring my beta down as a company? Beta measures risk to equity investors, right? So if I have any debt, what would you suggest I do? Pay it off if you can. because debt makes your equity riskier because it magnifies every risk you're exposed to. And I'm going to introduce a third component here, which I'll talk about. If you have a lot of fixed cost as a company, it makes your equity riskier. It makes everything riskier. So if you can bring your fixed cost down, so how the heck am I going to do that? The essence of outsourcing is you take what used to be a fixed cost and you make it a variable cost, right? I'm not saying it's good for your company, but on this dimension, it can make your beta low. The one thing you cannot do to bring your beta down is go back to a Bloomberg terminal and play games with starting point, ending point. Let's change the market index because that's not changing your beta. That's just changing your reading. I remember actually, and I've all my objective in exercise every morning when I exercise is try to burn off 1,000 calories in 40 minutes, which is impossible at my weight to do. So one day I entered a weight of 400 pounds. These stupid treadmills don't know how heavy you are. It's amazing how quickly the calories roll off when you're 400 pounds. But I'm cheating, right? In a sense, I'm not changing the actual calories I'm burning. So changing your parameters on a Bloomberg can give you a lower beta, but they're really not lowering the beta. So we're going to come back and talk about the drivers of beta. But more importantly, if you're the CFO of a company, I'm going to ask you, why do you want to bring your beta down? What's the big deal? You have a high cost of equity, but you have a high cost of equity because you're in a risky business with lots of opportunities. If you can deliver a much higher return on equity, you are going to get rewarded by the market. The cost of equities is half the game. It's what can you make in the business you're in. Because what will kill you is if you're a high cost of equity business, but the projects are terrible. That's a bad business. So if that's the case, leave the business. Don't even ask me what to do. Just liquidate the business, buy T-bills, give me a money market fund. I'd be happier than doing what you're doing. But lowering the beta shouldn't be high up on your list of priorities as a company. It's how do you deliver high enough returns on equity to beat that cost of equity? So I'm not going to torture you by going through the whole process from scratch for my other companies, but I did the beta page for Tata Motors. So let me go, and I left it at the Bloomberg default. The Bloomberg default is the Sensex. Every Indian stock that you ask for a beta for Bloomberg, it runs it against the Sensex, which already should make you a little wary because the Sensex doesn't have 500 companies. You're looking at a much smaller, much narrower index. Let's go down the output. The beta, raw beta is 1.83. You bring in the standard error, which is 0.16. With 67% confidence, it's plus or minus 1 standard error. So there's a big range on the beta. The R squared was 69%, but the qualifier that the index is narrow and Tata Motors is part of the index. So if I believe the regression, 69% of the risk in Tata Motors came from the market, 31% came from the company. The intercept was 2.28%. Remember what I said about the 2.282, that they're sloppy? That's 2.28%. You subtract out the risk-free rate, which is about 4% on an annual basis in a month. So convert to monthly times 1 minus beta gives me a Jensen's alpha of 2.56% a month. Annualized, that number was 35.4% a year for those 5 years. Clearly, that's an amazing alpha. What did Tata Motors do between 2008 and 2013? It must be something explosive. Jaguar Land Rover, which we said is usually a bad idea, right? Going and doing acquisitions. So unless you buy the right company from the right seller. You know who they bought Jaguar Land Rover from? They bought it from Ford in 2009. And what was happening in 2009 to every single automobile company? Let's start with GM. GM had already gone bankrupt. There was an entire bailout. Every automobile company was teetering on the edge. Ford was desperate. First rule in acquisitions is find a desperate buyer. And there's no market price. So basically, they will take any. It was not just that they bought Jaguar Land Rover, they bought it at a bargain basement price. What I'm saying is when you compute the Jensen's alpha for your company, pause and ask a question, especially if it's a big positive or a big negative number. What happened in my company during this period that might explain the Jensen's alpha? You might find nothing. But usually there's a big trigger when you see big Jensen's positive or negative Jensen's alphas. With 23andMe, the trigger was that somebody hacked into their database with all the genetic information on 7 million customers of 23andMe. That's going to devastate your business model. With NVIDIA, it was the launch of AI and how they had the chips to essentially be the first mover in that business.
So don't just leave this at numbers because it's easy to compute the numbers. Look behind the numbers to see what it tells you about the company.
For Vale, I was able to run two different betas. Why? Because Vale has a Brazilian listing. You can get a beta against a Bovespa. But Vale also has ADRs, which are listed and traded in the US and US dollars. And when I ask for a beta for the ADR, and this shows you how inconsistent Bloomberg is, it goes to the S&P 500, it says in ADR. I get very different betas, 0.89 against the local index, 1.37 against the S&P 500. Now I could ask you which of these betas is better, but the answer is they're both crappy. And the reason I put this page up is to show you how easily I can fool you if you let me fool you, right? So if you ask me to get you a Bloomberg beta page, and you give me enough time with the Bloomberg, I can deliver whatever beta I want for this company by playing games with indices and starting points and ending points. So when you look at a beta for a company, remember, somebody's made choices along the way that gives you the beta that you did. Another reason to mistrust regression beta is a lot of gaming that goes on. Final point, for Deutsche, I actually ran a beta against the DAX, but I also ran it against the FTSE Euro 100, because after all, now German stocks are part of European portfolios, not just German portfolios. Very different numbers. For Baidu, which is a NASDAQ listed stock, I ran it against the S&P 500 and the NASDAQ. Again, I'm not saying these are all good betas, because clearly given a choice in the S&P 500 and the NASDAQ, I said I'd go with the S&P 500, even though Baidu is not part of it. And given the choice between the DAX and the FTSE Euro 100, given how the European market has evolved to become investors investing across European countries, I would much rather trust the Euro 100 rather than the FTSE, than the DAX, which is 30 stocks, and Deutsche happens to be one of those stocks. So if you get a chance, get on the Bloomberg. It's better to get on earlier in the semester when the Bloomberg is relatively unattractive to people, and get the stuff off. And that's why I'll send you a link to the Bloomberg packet again. It's like 4 commands. It'll take you 10 minutes. You can print off all the material you need for this class for your company and have it available. Because while Bloomberg has no access to special private information, there is information that's easier to get on the Bloomberg than elsewhere, especially trading information, the beta pages. So I will send that link out after class today. But I will see you in class on Wednesday.